Regulatory fragmentation and arbitrage risk have become major challenges in the global financial and digital economy. Because countries develop rules at different speeds and with different priorities, companies often face an uneven regulatory landscape. This inconsistency creates gaps that sophisticated actors can exploit, leading to regulatory arbitrage. As a result, risks increase for consumers, financial systems, and governments. This video is all about how fragmentation occurs and how arbitrage exploits it. Keep watching till the end, because understanding these hidden gaps in global regulations can completely change the way you look at financial risk. Let's get into the video. What is regulatory fragmentation? Regulatory fragmentation refers to a situation where different countries, or even different agencies within the same country, create rules that do not align with one another. Instead of a unified structure, the result is a patchwork of conflicting or overlapping regulations. This happens due to varying political priorities, economic conditions, and institutional capabilities. In sectors like crypto, data protection, and cross-border finance, fragmentation makes compliance harder and increases uncertainty for both businesses and regulators. What is regulatory arbitrage? Regulatory arbitrage occurs when companies or individuals exploit differences between various regulatory systems to minimize compliance costs or avoid strict oversight. For example, a crypto exchange might register in a country with weak regulations but operate globally. Similarly, banks often shift activities to jurisdictions with lighter capital or reporting requirements. Arbitrage doesn't always involve illegal action. It often remains within legal boundaries, but it can undermine regulatory goals and increase systemic risks. Why fragmentation has increased in recent years? With technologies like blockchain, digital assets, AI, and cross-border payment systems expanding rapidly, governments are struggling to regulate them at the same pace. Some countries adopt proactive, strict rules. Others choose a more relaxed, innovation-friendly approach. For example, the EU introduced the MiCA framework for crypto assets, while many countries in Asia and Africa are still developing basic policy structures. This uneven regulatory maturity fuels fragmentation, and naturally, arbitrage risk grows wherever gaps exist. Impact on financial markets and stability. Regulatory arbitrage can shift high-risk activities into less regulated markets, increasing systemic vulnerabilities. For example, before the 2008 financial crisis, banks shifted risky off-balance sheet activities into jurisdictions with weaker oversight, contributing to global instability. Today, similar risks appear in cryptocurrencies, stablecoins, and decentralized finance, DeFi. When large players use weak jurisdictions to bypass rules, regulators lose visibility, making markets more vulnerable to fraud, liquidity crises, and investor losses. The role of cross-border activities. Most modern industries operate globally, not locally. Cross-border transactions allow companies to choose where they register, where they run servers, and where they report financial data. This flexibility becomes a challenge when regulations vary widely. For instance, crypto companies often claim to be offshore, even while serving millions of users worldwide. Cross-border business models make enforcement and oversight extremely difficult because regulators often only have authority within their own national boundaries. Fragmentation in crypto and digital assets. The crypto sector is the clearest example of regulatory fragmentation. The US, EU, UK, Singapore, UAE, and Hong Kong all have different classifications, tax rules, licensing requirements, and consumer protection standards. While the EU's MiCA aims to create a unified approach, the US still struggles with SEC versus CFTC jurisdictional conflict. As a result, companies relocate frequently to avoid stricter rules, creating arbitrage opportunities. This is why many high-profile collapses such as FTX involved offshore jurisdictions with weak oversight. Fragmentation in data protection laws. Another example is global data protection frameworks. The EU's GDPR is one of the strictest models, while other regions, like South Asia, Africa, and Latin America, are still developing patchy privacy laws. Companies often store or process data in jurisdictions with fewer compliance obligations. This creates arbitrage around data residency, user consent, and cross-border data transfers. The result is inconsistent protection for users and compliance complexity for multinational companies. How arbitrage undermines consumer protection. When companies operate from countries with weak consumer protection or financial safety laws, users face greater risks. Fraud, misleading advertisements, unregistered investment schemes, and poor dispute resolution mechanisms become common. Without standardized global rules, bad actors can easily move operations to safer havens. Consumers end up exposed to unstable platforms, hidden fees, or scams, while regulators struggle to enforce penalties across borders. Global efforts to reduce fragmentation. Several international bodies are working to reduce fragmentation. Organizations like the Financial Stability Board, FSB, International Monetary Fund, IMF, and Financial Action Task Force, FATF, push for harmonized global standards, especially in crypto, anti-money laundering, and bank regulations. A coordinated international effort is essential to create aligned, flexible, and forward-looking regulations. Only through harmonization can governments limit arbitrage, strengthen oversight, and ensure safer and more stable economic systems in the future. That was all for today's video. If this opened your eyes to how big of an issue regulatory gaps really are, share it forward and tell us which topic you want us to uncover next.